Yep. So another episode where I'm forcing you to check in on the stock market.
Yeah, it's great. Thanks for giving me reasons where I have to look at my portfolio, you jerk. Something I try pretty hard not to do.
Yeah. So how did it look?
It's down more than it was the last time I looked. So I don't want to say I'm surprised, but I don't exactly need to see the number because what am I going to do with it? I guess we'll talk about it.
We're in May of 2022 here, and the last kind of episode, which was prompted by me saying, "Hey, the market's down, man. Let's chat about that. That should be relevant." And just, that was just in March. So just a couple of months ago, we're at May 10th, and that was actually, I think it was March 9th that we chatted last. So
I believe you.
Yeah. Oh man. Here we are again, Jay.
Here we are. And maybe this is just the second of, 28 months like this. No, for your sake and mine, I hope that's not true.
Yeah. Well, I don't want to rehash everything that we talked about last time because I think that that's still a really relevant episode. And actually, I was looking through the comments of that just to see what other people had to say and their reactions to it. It was nice actually for me to hear, not only just to talk that through with you, but also to hear the support and read the support in those comments and just hear how other people manage it and deal with it. Because there are a lot of people who are like you, like, I have a great plan. I'm just setting it and forgetting it. And I think that is great if you can do that. But there are also a lot of people that are like me that are worried, anxious naturally. And there's plenty of people telling me just to chill out, which I hear often.
There's merit to all of it, right? I mean, and that's not to say that I'm not worried that we're entering a long downturn that turns into a recession, right? Of course, that's on my mind, but I know that today, the market doing what it's doing and what it has been doing lately, I'm not going to change anything this moment.
Yeah.
Which we'll talk about, but that answer will be different if things progress, right?
Yeah. And so I that's kind of the next level of what I wanted to, that's the next place I wanted to take this discussion was, okay, we've talked about the broad overarching emotional aspects of a market downturn. And many actually in those comments said, hey man, this is just a blip. And I think we mentioned that in that episode too, like zoom out. If you're ever feeling really worried, take that stock chart and just zoom out because you're going to recognize that this is actually a blip. And but it doesn't negate the fact that when you're in the moment, it can sting a little bit. And I did want to drill into that, really the mechanics of things we can do maybe to be more proactive. Because in this situation for me, and I don't know how it is for you being post-FI, but I always feel better if there's something that I can actually do. So I was trying to think about different, even if they're micro steps, things we could do. So how about you? I mean, what do you do in these kinds of situations? Do you literally just look the other way and say, nothing? Is that your answer?
Yeah, I pretend it's not happening. No. And I think, you hit on something without spelling it out exactly, but I'm sure it's on your mind too. And that is what we do and how we think about it is going to differ depending upon where we are on our pre-FI or post-FI journey, right? And what you do within 2 years of your hopeful date versus someone who's 20 years or 15 years from their hopeful date, it's going to be totally different. So for me right now, I have started with, 2 years cash reserves when I stopped my job about 2 years ago, and I've done one refill since then. So now maybe it's 1 3/4 years or something like that. Right. And I'm not selling anything right now for obvious reasons, right? It would be taking a loss that I don't need to take, but I am at least increasingly cognizant of the status of everything. So, I like to talk about not looking at things all the time. And that's true. I don't. But I did certainly recently go in, do kind of an inventory. Where am I? How am I doing in terms of my asset allocation? Not that I would want to rebalance necessarily right now anyway. We can talk about that. But I'm thinking more like future looking. If this downturn continues, at what point will I think about, all right, I'm just going to keep riding this and let the cash bucket drain? Right. Or am I going to have to at some point, and when is that point, think about refilling it? That's kind of where I am right now.
Yeah, I was going to ask you about the actual mechanics of refilling that bucket. And I know this is all new to you, but in principle, how does that work? Are you just looking for market highs and you're saying, okay, this is an opportunity for me to fill this up? So let's say, December of last year, things are riding pretty high. I mean, of course, looking back, you're going to know that's the high point of the market, but how do you approach that?
So there's a couple things that come to mind. The first is kind of like the trickle fill. So in my taxable account, as dividends are thrown off, I have them set to not be reinvested. And that's for a couple of reasons. And one of those is tax loss harvesting that we can talk about. But the other is it's an easy way, if I don't want to buy something, to send money to that cash bucket that I can then spend. And I didn't have to sell anything. Those dividends come no matter what, tax realized or what have you. But the second way I would refill it is selling. And so last year when the market was higher, did do some refilling by selling in my taxable account.
Okay.
Being mindful, of course, of gains and the tax treatment of those. That's important, of course. But then the next opportunity to do it would be as a part of just normal rebalancing. So as my asset allocation moves sufficiently away from my target, I would consider selling something. So the overall strategy for me is keep an eye on it on at least a quarterly basis. And if I would need to do or want to do any rebalancing, that would be an opportunity potentially to send cash into that bucket versus, just buy something.
And you're doing this in taxable because this is the phase that you're in that sort of bridge period before you can reasonably access you've opted not to access your pre-tax accounts, right? You haven't done the sort of rule of 55 or anything like that. So you've set aside,
that's right.
You've created basically an off ramp for yourself in the taxable account to do that. And so
that's right.
We always talk about trying not to time the market, but that is really, you are actually being opportunistic, right? In terms of how you're selling those things off.
Yeah. And it's about, if you don't need to sell things, well, then just kind of wait. I think Fritz explains this from the Retirement Manifesto better than I'm going to, but the way I think about it is keep an eye on things quarterly. If market conditions are as such that I want to take money out of the portfolio, there are gains realized, and I want to take them out and it will help me maintain my asset allocation anyway, take them out. Or if my funds are low enough such that I need to generate cash, well, then it's a no-brainer, right? We need to be able to fund our lifestyle, even if we, pull, expenses in, right? Spend less. There's still money that needs to be generated. But I suppose you're right. I don't really think of it that way, but you're accurate that it is a kind of timing the market to decide when to sell things and when to just let it go. And I guess for me, that's why I like having a long buffer. And some people would say it's short, right? 2 years isn't very long, but it's long enough that I can sort of see where things are going and make decisions periodically as to whether to sell them or not.
If I think about holding 2 years worth of cash, what's the average bear market? Is it 3?
Yeah. This table was making the rounds on financial Twitter today. It showed like the length of every bear market. And of course, some of them, I'm looking at early 70s right here.
Oh, geez.
They're really long. And so, yeah, you don't know, what is long enough to where you would get out of that situation, right? But you can't know that. None of us have a crystal ball.
Right.
2 years isn't very long for most people.
But cash is one part of your portfolio.
It is.
And you also have things like bonds and treasuries, all those exciting things, right? So
yeah,
I presume if this rides out, let's say beyond your 2 years worth of cash, like what's that plan look like? Because I know you have a plan.
I do. And thank you for being confident that I have a plan, but I have this, ballast, we often refer to it. I think I stole that word from you. I have that fixed income in my taxable account. It exists in various parts of my asset location strategy, but I have, intermediate term treasuries and a total bond fund that I can sell before I would have to even think about selling stock when I didn't want to, right? If the stocks are down a lot and I don't want to sell them, I have this. Now, of course, right now, somebody's starting to type a comment saying, well, bonds are down too right now. And they are. And sometimes they are more correlated, at least directionally, if not in magnitude, than other times. So right now, both are down. I'm glad I don't have to sell anything. But very often, as people run from volatile equities to fixed income, they will stabilize, certainly, or they'll be down less than stocks are.
Right.
And I would sell those. Yes, I would not have to sell my equities.
And if we think back to Fritz's bucket strategy, which I know you're employing and I plan to employ,
Yeah.
cash is bucket number one, right?
That's right.
The bucket closest to you. That's where you're reaching in and, you know, funding your lifestyle, your everyday life with.
That's right.
Bucket two is the bucket you were just speaking about, right?
Yes.
These assets like bonds, treasuries, things like that. And then bucket three are the stocks, right?
That's right.
And so it is this kind of strategic game of when do you dip into what bucket? I mean, it's obvious that you're going to be spending down the cash in a prolonged downturn, but less obvious when you get to bucket number two, I would think.
Yeah, I think so. But I think to another point that we often discuss is having a cash position and is giving me optionality.
Yeah, right.
Right. So I don't have to do something right now. If I get to the point where I simply must do something, right, I pulled other levers, decreased spending, looked at opportunities to bring in more income. Well, yeah, I'm going to sell bonds if both bonds and stocks are down. But I have options. The option here is to be able to wait right now because I'm using my cash. Right. And I'm also, maintaining my low withdrawal rate. I'm still withdrawing at below 3%. I'm at 2.7% on the year. So I'm doing the things I think I should be doing right now, knowing that I have time on my side presently.
Do you have any automated means for checking in on these things, or is it really just like rebalancing, for example, or is it you physically have to go in and look at your portfolio, which I know you're loath to do?
Yeah, so I have a dashboard that I built. I know you'll be surprised in Google Sheets because I don't pay for Excel these days. But I automatically pull in current stock values and such using Google Finance, and that gives me a snapshot view at a glance of what's my asset allocation versus my targets. And this is something we could easily share, I think. But then also how many years of cash, right, and fixed income in my taxable. And so at a glance, I can tell where are things relative to the last time I looked. I don't have to dig down another level if I don't want to, and I often don't if there's no utility in it. But it's not automated per se, Eric, but I can at least see what is happening, and I have a simple modeler that I built in where I could look at the impact of buying or selling something and how that changes, for example, by asset allocation.
When we talk about rebalancing, that was one of the things that came to my mind as a proactive step that I could do. The idea with rebalancing is that you have a certain asset allocation. If it's a 50-50 bonds to stock allocation, part of your portfolio that's allocated to stocks is going to, over time outperform and become a greater and greater percentage of your portfolio. And so in order to maintain a similar risk profile, that 50-50 allocation, you have to over time rebalance the two.
That's right.
And there's been a lot of sort of scholarly, research done on this, optimal rebalancing times and things like that. And I'll tell you, I was approaching it like, well, I want to juice the returns here. I wasn't even thinking about risk. I was like, I don't care about risk. Like, okay, my bonds are naturally going to be, they're down, stocks are down. Well, maybe, I'm outside of my 70-30 allocation that I had set for myself. Maybe I can sell off some of these bonds and buy some of these stocks at a real discounted price, right? And that is not actually the purpose, having read a number of papers just recently. That's not actually the purpose of rebalancing. It's actually to reset your risk profile.
Correct. That's right. And you said it all there. I mean, and this is the balance. It's definitely very clearly the balance for me right now. And it also is, I'm sure, what you're feeling with, a couple of years to your target, timeline, the same thing you have to be thinking, because it's so tempting, this idea of like dry powder and buying opportunity.
Totally.
And that's a very different calculus if you're 10, 20 years from early retirement versus, oh boy, I'm almost there, right? Because you're trying to manage risk. And that is absolutely what rebalancing is all about, is maintaining that risk profile that goes to your asset allocation, which you set in your individual, your investing philosophy statement.
I'm always fighting with myself about risk though, man.
Yeah.
It's like,
It's because you're so risk forward.
well, when things are on sale, I just want to buy. I just want to buy, right? I mean, that's where we're at right now. And I think if you're, like you said, pre-fi, early, even mid-stage, like this is an amazing buying opportunity. And if you have more to put in, now's the time to put it in, right? Within reason, obviously. I mean, for me, as I'm getting closer, I'm like, well, things are looking not so rosy right now. And it feels like the date is slipping further away from me because the more I put in, the more it goes down. And so I'm just looking for any kind of action that I can possibly take. Let's talk a little bit about the mechanics of actually rebalancing, because there is some nuance to it, right? A lot of this research, like if you look at the Vanguard research, it's on like a 50-50 portfolio or a 60-40 portfolio, stocks to bonds. Let's talk a little bit about the nuance of that. When your portfolio gets to, let's say, 80-20, and you really wanted it to be at 70-30, like, how do you go about doing that?
Yeah. I mean, for me, I think one of the most important lessons, and you already said the first one, which is this is about maintaining a risk profile. Yeah. I think the second one is about being consistent. Because when I read those studies, the ones you're talking about, the Vanguard one, Michael Kitces had a really good one a few years ago. You want to be consistent, because the short answer from all those different simulations was there's not necessarily an ideal frequency or sort of thresholding approach, right? If it changes up or down by this amount, that's ideal. It's more you want to come to a sensible strategy and be consistent with it. And so for most people, that means rebalancing at some regular frequency, right? Maybe once a year, maybe twice a year, maybe at most quarterly. And then having thresholds where if it is exceeded up or down, right, your asset allocation is shifted by a certain amount up or down, then that triggers the activity. And so activity means buying and selling to reestablish the same blend that you had. So in your case and mine, 70-30 stocks to bonds.
Right. Yeah. And it's important to look at that also, like, a 30. So if we say, look at some of the research that was done, and you and I both read Kitces quite a bit, I think.
Yeah, for sure.
And I really like he's got just the right amount of detail in there, backing it up with studies, and he's got charts and graphs. But it's also, he also provides an abstract. So it's totally,
yes,
the information it's really accessible. And so one of the things he was saying was, it seems like there's an optimal, he did all this sort of back testing.
Yes, he did.
Of portfolios. And we'll definitely link that up in the show notes and the description of the video below. But he kind of settles on this optimal rebalancing strategy of like 20% up or down for that asset class's allocation, right? And it's relative to that percentage. And that's the important part. And I actually didn't fully appreciate that until I read his article. So if you have a 30% bond allocation, right, it's not going to be, you don't wait for it to get to be 50% or 10% to, start the rebalancing procedure. It has to be 20% of the 30. So it's actually a much narrower band, right? So it's 6% plus or minus.
That's right. 24 to 36% in the example you gave.
Yeah. And so stocks would be the same thing, right? If it's a 70% allocation in your portfolio, 20% of that is going to be 14. So plus or minus. When you have, let's say you have a 2-fund portfolio, stocks and bonds, time to reallocate the bond portfolio, right? What do you do with it? Naturally, you're going to move it into stocks, right?
Yeah.
Okay.
You gotta. I mean, that's all. I mean, simple enough. That's what I do. I think the only thing that adds complexity, and I know you haven't had to do much of this yet, but when you did your exercise that we talked about in previous shows, right, shifting from a 100 and 0 to 70-30, you also have to take into account asset location.
Right.
Right. And so you could, be creating taxable events. And if you can avoid those and you want to avoid those, if you can use your retirement accounts to do that, your tax deferred or your tax free accounts like your Roth account, you can do that too. But I think for me, that's where the complexity comes in, even for a 2-fund portfolio. But yeah, it should be that simple.
Yeah. The one thing, and maybe people will appreciate this more than I did before reading this article, is that you're naturally shaving off return from your portfolio when you rebalance. Yeah. And they talk about many different strategies you can use, and actually the higher you let those bands tick. So let's say if it's 20% absolute, your portfolio return is actually going to be higher over a longer period of time. It doesn't mean the risk adjusted return is going to be higher, right?
Exactly.
So that's that's the nuance there. But you get a higher portfolio total return versus the risk adjusted return. But if you are someone who's post-fi and you need that money at a certain point, that may not work for you. That may actually be a bad event for you. So it was interesting because, you're obviously with rebalancing on a market that's moving up, you're selling the winners and you're trading it for the losers. So, which is why it's kind of psychologically okay for me right now when in a down market. It's like, well, I want to be able to pick up some extra stock in the portfolio, but it's not necessarily going to juice the returns in the way that I was initially thinking. The one exception to that is if you are trading assets that have a similar sort of risk profile. So if you're rebalancing within, say, for me, VXUS versus a VTI. So you're going for an international fund and the total stock market fund, that can have a juicing effect if you time it right. But again, here it's like, we're not trying to time the market necessarily. So it's nice having these rules. I actually really appreciated that Kitsis article because it's like, okay, here's a solid rule. And that's why I was asking you before. Do you have some kind of dinger on your spreadsheet that says, ding, 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 time to rebalance?
Yeah, it's annual. For me, my intended approach is annual rebalancing and 20% relative thresholding. Okay. And I have my tool, the tool I'm mentioning, I probably wasn't as explicit as I needed to be, actually calls out, it throws a flag in red font if any one of those asset classes falls plus or minus 20% or greater of my targets. And so then I'll know, okay, there's an opportunity to do something here, and then I can model the impact of different decisions I might take. So yes, my intended frequency is annually. I love that in both articles, and obviously we're going to link both of these, the Vanguard study and the Kitsis article, they say the same thing, which is irrespective of what you do, you should be consistent. But his article also does those, simulations of, well, what if you rebalanced at every opportunity you could versus the periods that we're talking about here, the, twice a year, quarterly, annually, what have you. And, risk adjusted return was best under what we're talking about. So yeah, that is how I will do it. Now that to your point, if you needed to sell, along the way to raise money for bucket one, well, you have an opportunity then to do rebalancing anyhow. Yeah. Right. Because you're certainly not going to sell. You don't want to sell things that are going to put even more out of whack versus your targets.
I really like that as the post-fi strategy. That's something I'm going to really make note of here. You mentioned that you have a spreadsheet, some low-level automation in there. I don't actually use a spreadsheet for that, although it sounds like I might need to. I've just been looking at through Personal Capital. Do you ever use that site at all?
Yeah, I used to, until I built this spreadsheet, I exclusively used Personal Capital. It's so easy, and it's free.
Yeah. So, and Personal Capital, basically you link all of your accounts in there. So, you can link bank accounts, you can link crypto, all of your brokerages, and then it does kind of a real-time pull-in of all the information that you have. And then what I like about it most is that when I'm looking at asset allocation, I can go over to a listing of the accounts and I just click on asset allocation and I can see where my bonds are. It's separating out between international bonds and government bonds and, corporate bonds or whatever. It's very granular in that way. And then there's a stock allocation, international stocks. And then obviously if you have individual stocks, which I don't, you can look at those too. But I just find that's a real handy tool to use. I think they have an app for your phone too.
Yes, they do.
Yep. And totally free. So we actually have a link that if you want to use it and try it out, you can use our link to sign up for it. And I think they actually have some advisory services too, depending on how much the value of the accounts that you link into the site are. But yeah, definitely a useful tool. I will say, I went in there to look at it recently and it didn't fully categorize all of my like bond positions. So it was actually leaving some of them out. So something to pay attention to. Things weren't adding up. I was like, oh wait, we're missing something here. So no tool is perfect, but I really like for a graphical interface and a kind of broad brush overview, that seems good. You use your spreadsheet though to like, if you want to rebalance into, and you have a more complex portfolio, you actually do need some level that's beyond personal capital, right?
Yeah. But I think, given the sort of stage of the bulk of our audience and where they are on the journey, I think it's a really wonderful tool, especially for earlier stages. But yeah, the main reason I like my approach is because I have a little bit more complicated. I still don't think it's complicated, in terms of the number of funds. And I like the ability to sort of interactively plug in the, potential buy or potential sale and see what it does to everything else. It just makes it easier to plan trades.
Yeah.
No, so that's why I have a spreadsheet approach.
Yeah. I bought a really detailed spreadsheet, financial planning spreadsheet, and I love it, but man, it's taken me so long to really get my head into it and plug in all the data. And I could see once it's built out, it has like, I don't know, maybe 50 tabs at the bottom of this thing. It's like, oh,
50.
Yeah, it's a lot.
Oof.
It's a lot, but it captures all of estate planning and college planning and, a lot of different things. But as part of that, it has an asset allocation and a rebalancing tool. So you put in your funds and everything. And then, if you need to get back to a certain allocation, it'll tell you what to sell, what's overweight, what's underweight. You can set different bands and things like that. So there are a number of tools available and out there. Personal Capital is free and could set it up this afternoon, basically.
Yeah, and seems to be one of the most popular, honestly. It's talked about on most of the podcasts I listen to, and there's some pretty good guides out there as to how people use it as well for their FI journey. So that also is always appealing to me if there's good information out in the community.
Yeah. I mean, there's many ways to do this. I don't personally use Wealthfront or Betterment, but I know there's these kind of
robo-advisors.
Advisors, right? And that's one of their claims to their real value, right? They can do automated loss harvesting and automated rebalancing. I was actually looking some of those up today. That's like 25 basis points, a lot of those, or more, or 30, or I mean,
the fees on those.
Yeah, that's significant. And I look at the difference between, what you were just talking about in terms of the frequency of rebalancing and how it impacted portfolio performance over the long term. It's like, well, you might as well just let it sit.
Well, here's my thought on that. I mean, I see the merit or why people would find robo-advisors attractive, right? The fees are relatively low compared to other approaches to getting, support through advisors, planners.
Like a 1% fee, for example.
Yeah,
right?
No matter what kind they are. Okay. And it automates things that could be annoying to think about, or if you don't want to think about because you find them tedious, like loss harvesting. On the other hand, if any of your portfolio lives outside of a robo-advised account, you're now at risk for wash sales and violating the wash sale rule. And that could be a real problem, right? I mean, it'd probably be useful to explain that.
Yeah, that's a good point. Yeah, because it may not fully capture other trades that you're making outside of this account. And if you are buying similar securities or the same security within 30 days before or selling it 30 days after, you're going to trigger this wash sale rule and effectively negate the loss.
Exactly, right. You can't claim that loss. You're going to have that capital gain without the offset you were hoping for from loss harvesting. And so that's my concern if people are using, one of those robo-advisors, but they still have other accounts and they're reinvesting dividends and things like that. All of those things. I mean, I triggered a wash sale within a month of going out on my own. Now it was a matter of, a few, it was dollars. It was something silly. But so it was nothing big, but I mean, if you don't have that set up right, yeah, that could be a problem. So it's at least something I'd put out there for anyone who is thinking of using or is using robo-advisors. Make sure you understand your full financial picture and avoid the potential to have a wash sale rule violation.
Yeah, totally. That's a good point. I'm want to do it manually just to understand it, if nothing
Yeah.
else. But also, the manual process here of rebalancing can be as simple as, like me, if I'm making regular buys, that's another way of rebalancing into this market. And
Totally.
one of the best ways for me to feel more proactive at this time, feeling like, okay, I can actually affect some change here and feel in control, even when the markets are kind of really volatile right now.
Absolutely. Well, and when I was thinking when you were saying that, like, this is one of the advantages of having, a simplified portfolio like you do, whether it's a lazy 3 fund or 4 fund or whatever. When you go to rebalance, if one thing goes out of whack, and you don't have to adjust all these different things that could have moved, small amounts, but enough to trigger, oh, okay, now it's out of whack. The simpler it is, the easier all those supporting tasks are, and that's a good thing.
Yeah, that's a good point. What are some other opportunities people could look at here? I was thinking Roth buys would be, this is a great time to get money into a Roth, whether you're going to do that through the back door or you can just fund it directly.
Yeah, well, I think particularly if you're, earlier on your FI journey, this is a buying opportunity, right? Everything is on sale. Roth it's a great time to take advantage of Roth. Maybe just overall, is there a way to increase your savings rate, even if it's temporary, right? Can you delay, purchases you were thinking about making? Take advantage of those low prices if you're able to. Seems like a very opportunistic case for me, and I'm seeing evidence of that, online, people talking about it. I think some of them are equally as worried about what it bodes for the future, but they're still taking advantage of, like, right now I can get some sale prices.
Yeah, and it actually does. We should mention putting some rules in place on that too, because I remember Fritz, when he was talking with us, saying like, oh yeah, the first time the market dropped, I forget what this is, in 2008 or when it was, but I think it was. I went in with a bunch of cash, and then it dropped again, and I went in another, and pretty soon he was out of all the dry powder he had, and the market still had a ways to go. So even though sometimes this market can feel volatile and like it's just going down, 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 down.
Yeah.
When you zoom out, it's not really that much of a hit, 20% market correction, 30% down. Like you have to expect that in a 10-year period, right?
Totally.
Yeah. So set some rules up, and he did have a good rule set with respect to that. For every 1% that the market went down, he went in on his dry powder position. He went in a certain percentage. And I just, like, with all of this, it's like, okay, you get to this situation which feels out of your control, put a rule set around it, and then you start to wrest back that control. And it just feels like, for me, it's kind of like creating this armor around me. It's like, okay, I can survive this. It feels better to me.
I think the more rule sets you can have, the better off you're going to be. You don't want this to be some, like, huge pile of, rules that create just work for you. But I've seen investment policy statements, IPSs, that actually have some rules in them, not just their asset allocation, but also, I will do this when this happens, and just have a few of those kind of core things in there. It's a good reminder to yourself over time too. What are the bounds? What are the practices I put in place so that I'm consistent with them.
Do you ever consider using some of your cash position to do that at this point?
It's tempting. It is tempting. I know that I shouldn't, and so I have not. The one thing I did do, Eric, and I don't think we've talked about this on the show yet, is I did take $20,000, $10,000 each for me and my wife, Lori, and took them out of cash reserves and put them in I-bonds.
Okay, interesting.
Because, again, if you have 2 years of cash, well, we can afford to wait a year for a portion of that. And I know that this isn't like You're not talking about big gains here, but
It's what now, 9.3%, something like
yeah.
that.
So I'll get the 6 months of the one and 6 months of the other.
Right.
And obviously, if you sell it before 5 years, you give up the last 3 months of interest. But still, if I have that cash sitting there anyway, losing money with inflation,
Right.
well, why not put some in there? And so, if we find ourselves in this situation again, that when I'm eligible to buy again, well, maybe I'll do more of that. So I know that's a pretty low risk thing to do, but it still is opportunistic.
Yeah.
So that is something very small that I'm doing that has some impact.
That is nice. Yeah, I'm glad you mentioned that because it's all over the FI headlines these days. Like everyone's talking about getting I bonds. I'm like less bullish on I bonds personally. I don't love them as an opportunity. Like for me personally, I'd rather get it in the taxable, buy some, equities with it.
Right. And you're still buying.
Yeah.
Right. So you're in a different situation than I am, where it's like, well, here's a little thing I can do that's low risk to make some extra gains, even though it's not material on the bolus of my portfolio. It's still something.
No, I get it. Yeah. And if I were still trying to achieve a bond position, my bond position is now overweight. Like it's nearing my band, and I have a similar band as you, 20% of the 30%. So I'm nearing my band where I need to start to sell a little bit of that and load up on some stocks. But if I weren't there, yeah, I'd probably consider it, but I just feel like it's more, I feel like I can control the tax hit on that differently. Because I don't know if I can really truly consider that a cash position for, let's say, loading it up for the next 2 years, right? So I'm going to start building a cash position, and that's maybe another question for you. But if I'm thinking about retiring in 2 years, I need 2 years of cash or 18 months worth of cash.
If you want to follow a similar strategy to what I did and what Fritz did, he's got 3 years. I think I have 2.
Right, but I don't know. I prefer the capital gains tax treatment because when you sell the I bonds, right, that interest is just going right to your marginal tax rate, right?
Right. On the same note, I'm also
you're controlling that.
I'm controlling my income.
Yeah.
I think most people in the fire community, or many people in the fire community, are familiar with Go Curry Crackers series on, the first $100,000 of gains is effectively tax free.
Right.
That's another thing we can link up. But if you could stay below that 0% capital gains limit, well, not such a bad thing. And managing your income is important, not only for that, but also for, in the United States, obviously here we're talking your Affordable Care Act, your medical subsidies.
Absolutely.
So if that's something you're counting on, then that's another consideration. You're talking about bonds reminded me of this comment we got on the show recently, and it was effectively somebody was saying, well, my position is effectively 100% stock versus your 70-30. And the way they were justifying it under current conditions was, well, SPY, S&P 500 is down at that point, I think almost 14%, 13 point something percent. And whichever bond fund he picked, it might've been BND, was down 9%. So minus 13, minus 9, it's basically the same thing in his words. So why don't you just go stay with 100% stock? How do you feel about that?
Well, I think you did the math on it, didn't you? Wasn't that your comment reply? The 70-30 allocation. I mean, we're doing this for a very specific reason, and that portfolio is not down nearly as much as the 100% stock portfolio. So
that's right. And I'm not poking fun. I mean, honestly, first of all, percentages are tricky, right? Relatively speaking, one is down 40% more than the other. But on the same note, I get how it feels like everything is down a lot, and that's because everything is down. But on the same note, this isn't just about total return, like we talked about earlier. This is about, managing risk appropriately for the longer term, right? And so we try hard, as much as our brains are wired for that sort of instant input and reaction, that we're not just managing today, right? We're looking a lot farther ahead.
Yeah, and I think this also makes a case for, here again, we're going to talk about optionality, right? If you get into a situation where you need to rebalance or, you need to make some moves. If you only have one thing in your portfolio, there's not a lot of moves you can make, right? It's certainly no way to optimize those moves. So for as much as I sort of lamented making that decision to go to a 30% bond position, it's helpful for me to kind of test it in a situation like this, where if I fast forward to where you're at, like, okay, hey, if I'm 2 years into this, like, I do want things to sell. And so it feels better knowing that that's an option I can take. I really do think it does make a case for, having a bond position. And I think there was another comment related to that saying, well, how come you guys aren't into dividend, paying stocks? And I mean, this is a comment we get almost perpetually.
Yes, it is.
On this channel. I think a lot of people in the FIRE movement, like, they think about dividend paying stocks because feels like a consistent source of income. What do you say to that?
Yeah, I mean, it's one of those things where I really need to write a proper formulaic response because it comes up so often. Yeah. But candidly, there are people in the FIRE community or in the financial community in general who believe dividend stocks are in fact the cure-all for everything.
Yes. That
they will solve any problem you have. And while there's nothing bad about having income, right? Dividend income is a part of anyone's portfolio, but the strategy of specifically picking funds because they generate high dividends as the main source or one of the main sources of income, at least is higher risk than I have interest in. Yeah, because of course it is a math exercise at the end of the day. That balance sheet, that valuation of the company has to reflect the payment of dividends. And, people will tell you, well, no, it does. The stock price doesn't go down in direct reflection to the dividend. Or if it does, it always comes right back. And that's not true. Mathematically, there's lots of history to look at. And yes, there are companies that more consistently pay dividends than other companies. And those are the ones get talked about. J&J comes up all the time, for example.
The aristocrats, right?
I can see people typing already.
The aristocrats, buy the aristocrats. There are companies out there who have never, ever cut a dividend. Because that's what I say. Well, we get to a time like this, companies are going to cut the dividend. What do you do then? Then it's like, it's a terrible time in the economy and things are costing more and you actually need more money and you're getting less from your portfolio. So what do you do then? It's like, well, I don't buy those kind of stocks. I buy just the aristocrats. And you can buy an ETF of all the aristocrats. But, look at the expense ratio on those. Like that has a different set of costs and it's fine. I mean, it's just a judgment call, right? You have to decide what is right for you, but also go into it eyes wide open, knowing that there's no free lunch.
That's right. And I like the way you put that. You're reading my mind here. I was going to say, it's not our position to say someone's approach is wrong.
Right.
I mean, if there's a flawed assumption in there, we're probably going to talk about, oh yeah, we get it right all the time. That's why we have so many episodes about all the mistakes we've made. But whether it's, really relying on dividend stocks for income, or I had a discussion yesterday with somebody about using extreme amounts of leverage as a FIRE strategy. I mean, that is a legal thing to do, and it might even be mathematically something that you've decided is worthwhile. But from a risk perspective, I have no interest in that. And I am going to ask questions if you come at me with that as well, why aren't you doing this? This is the best approach ever. Okay, I hear what you're saying, and I looked at your example. But honestly, risk mitigation is an important part of what we're trying to achieve because we're solving long-term math here, right? So if I have and you have 40 or maybe 50 years of lifespan left, well, we can't be taking all these dice rolls that might work out or they might go really wrong. So, you and I are on the same page with let's get fees as low as we can. Yes. Let's simplify the management of our portfolio and let's get as, appropriate exposure to the market. Let's diversify and let's be consistent in how we do that. And that works for us and a whole lot of other people. If you are comfortable with a much higher level of risk and a willingness to go back to work if you need to because you've tanked your portfolio, I can't fault you for that. It's just not the approach that I or you, not speaking for you, but you've made this clear, that's not what we want to do.
Simpler is better, I think. I did want to mention that, and when you're rebalancing, there's tax consequences potentially. So if you're doing it in a taxable account, obviously you have to pay attention to that. And there's also costs to that.
Yeah. Fees.
So, that's something else to consider. I think reading those articles should make it pretty clear that you should do it, but maybe once a year is probably fine. And for me, like, it always feels better to be opportunistic about it. And I know that's not the best, but that is one strategy. It's like, look at what the market's doing and you're in there making buys and you can make something of it. It's like you kind of, I'm going to refill the cash bucket, or I'm going to, rebalance into something like when it makes sense. I'm okay with that. Like fundamentally.
Yeah, I know. I mean, if there's any financial advisors in our audience still, if we haven't upset them sufficiently at this point, they would probably say, yeah, that's absolutely market timing. Be thoughtful there, because you are, are you following consistent strategy anymore? If you start, making, changes.
Tell me this, what's consistent about, rebalancing on your birthday?
Well, I mean, if it's annually, you've sort of, going back to the studies we talked about earlier, you're capturing, that movement, but you're not trying to micro do it.
Right. But if there's no difference between like a strategy that's like quarterly or daily or what, like, then why is opportunistic wrong?
Well, I think where the difference could come is from what you just said, is on a fees basis mostly, but otherwise.
But I'm doing it myself.
Yeah, if you're doing it yourself and you're, using funds that are, free of fees for trades because it's at the same brokerage, and then the downsides are a lot lower or a lot fewer.
And it's like I'm looking at a band, so I've got that rule set in place, so it hits the band, and then I'm like, okay, well, I'm going to do it here. Is that not? I mean, setting a band is naturally opportunistic, isn't it?
Yes, but it's a non-emotional way to do it, right? So I think that's the merit of it. You have a rule set. If it exceeds 20%, I will do something.
Okay. All right. So I guess I'm not opportunistic.
I mean, I think you are, if you're willing to do it. Like, as soon as it hits, I want to take advantage of that and do it. Yeah, that's.
Well, in a down market, that makes sense. In an up market, like if your stocks are riding up, then it makes sense to wait longer. So you set the rule. Maybe the rule set on an upswing is different than the rule set on a downswing. What do you think?
Yeah, maybe. I mean, I think to your point, as long as you're cognizant of fees and tax consequences.
Yeah.
I mean, what more can you do?
The only other thing that I really wanted to touch on, Jay, was this idea of like, I was feeling kind of demotivated about FI recently, and just kind of like, really? Not feeling like talking about it. And that might be a function of just like where the markets are going in the portfolio, looking at the portfolio. It's like, oh geez, I feel like I'm further away from FI.
Like retirement date risk.
Yeah, exactly. Yeah. And then we talked about that
makes sense.
In the last episodes. Like Laura and I are like, I don't know, should I take on more clients? Like I'm starting to have that discussion again. And one of the things that, I didn't tell you, I bought a boat.
No, you definitely didn't tell me. Well, I'm guessing you didn't buy a trawler.
I bought 2 boats. They're small boats.
Are they kayaks?
Yeah, they're kayaks.
I do like kayaks.
Oh man. Yeah. So we've lived here in Maine on the coast for 22 years, and we have gone out in kayaks, a handful of times with friends, or we, gone on tours and things like that. And Laura's been talking about it for a number of years, and I was feeling like, oh geez, that's just putting us further away from the trawler, which I wanted.
Yeah.
And I could tell she was kind of like, well, why not? Like, what are we going to do? Wait another 4 years or 5 years? Who knows how many years? And so one of the things that I was thinking about just to kind of get out of this funk was like, saving is a skill.
Yep.
But spending is also a skill. And
it is.
It's a skill that I haven't been used to. I haven't really been building that skill for very long. It's easy to save. And, we've talked about this before in the past. So I thought, okay, I want to get these boats, and, this will be a great experiential thing. This summer, there's a Maine island trail here. So there's a couple hundred islands off the coast of Maine, and there's a number of them that you can just travel to. There's there's trails and campsites, and it looks like a lot of fun, actually.
Sure.
And something for Laura and I to do. So we both got kayaks, and we're going to do that. And I was like, the moment I bought the boats, I was like, oh, I didn't feel good about it. It was so weird.
Because you took money out of the portfolio, or you weren't putting as much in, like you feel like you're.
Yeah, I wasn't putting as much in.
Yeah.
And we have this savings plan that we're executing on for our FI number every month. That's a certain number. And then because the 529 accounts are down and our son is going to school in the fall, our first college payment is due August 1st. And so we're not going to draw down in the 529. So we're redirecting some of the savings money to the college payment,
Got it.
but I just want to say these are all first world problems, but
of course.
they're real to us right now. And, when you think about saving for 529s, it's like, okay, that's what's going to fund college. But we started late on this, and we knew they weren't going to be fully funded by the time they started going to school. So we thought, instead of selling the stocks that are in there, they're all in target date funds, but still they're down. Instead of selling the stocks, we just redivert cash to that. So that's feeling tight, and I'm like, did I do the right thing here? And then my son's truck had a bunch of problems, so we just put a major repair into that. And it's like all these things are like, oh God, I just bought these boats absolutely the wrong time, man.
I'll tell you, I can actually identify with what you're saying more than you probably think, because we had a trip we were going to take with friends 2 years ago before COVID entered everyone's lexicon. We were going to go to Germany and go to a couple different parts of the country with friends, and that got postponed. Well, now we have it scheduled again. We scheduled it, just a few weeks ago, and we were looking at flights. And, while we have a budget and vacation spending is very much a part of that, because of what the market is doing, I was very much of the mindset like, well, I have some frequent flyer miles. Maybe we could use them and get some economy tickets.
Ooh.
And we could do. And Lori's like, are you kidding me? Like, look at can we at least get premium economy? Like, please, that's like well within the budget. It's not that much more. Like, stop trying to use miles. Like, let's get these flights that our friends are taking. It's better. Like, just please spend.
Yeah.
And she's totally right. And I would say I'm still building that muscle, and it is talked about in the fire community a lot, right? Like learning to spend.
Yeah.
Because my inkling is still like, well, maybe we should cut back a little more. But I will tell you, I'm gonna give myself a pat on the back, because I did what I talked about with you when you were out here visiting me, and I simplified my budget.
Oh, cool.
I took out so much of the granular tracking, and now I have big buckets like shopping, like, financial degeneracy, which
Alcohol.
is just like, dining out and beer and whatever, all that like fun stuff. And so it's collapsed. And so because I've like spent 2 years characterizing my spending and being good, I feel like, all right, I trust that we can do this. And so part of that is just getting more comfortable with spending and knowing that we're being appropriately disciplined. But the trip is definitely, I think, more similar to what you're talking about, where like letting it feel good to spend, even if there's a downturn, because you're within the framework you set up.
Yeah, Laura kind of said the same thing to me. She's like, well, we're still saving the amount we agreed to save for retirement, and we're still doing the college thing. And it's okay to have some of these kind of life splurges. And it's like, it's not even that much money. She bought a used boat and I bought a new one. And so it's like combined total, it's not that much. And so one of the hacks that I used, and I can't remember what podcast I heard this on, but someone said they were feeling guilty about spending something. So all they did was they saved 200% of the cost of the item that they were saving for. And they put half of it into their, retirement plan, and they put the other, or savings or whatever, and they put the other half into buying the thing. And so that's actually what I did.
Okay.
So that feels okay. But also now, having done that, I'm like really excited for the life's possibilities that opens up. Like, we're planning all these trips now. Like, we're looking at these, okay, how far can we go? And it's just like this whole skill set that it opens up. Okay.
Nice.
I love that about it. And sometimes there are these emotional barriers related to money, that once you get beyond them, you're able to see a different life. And, money it's a means to an end, right? Like,
it is.
It's not the end. It's not just it's not amassing the most. It's about creating the kind of life that you want to live for yourself. And I'm so appreciative that, it sounds like you have this too with Lori, that Laura is able to, hip check me every once in a while and say,
oh yeah,
by the way,
Lori has no hesitation in doing that, and she has the right to do it.
So next step is going to be like upgrading to first class, right?
No way.
Business class?
Not happening. Nope. Not unless the market goes on a tear. And, we're 5 years from now, and we're, I know, as Karsten very correctly commented on a recent video, which was exciting on one hand and terrifying on the other, you're never truly free of sequence of return risk, which he has written about, and he's absolutely right. of course, the risk decreases over time. It does not go away. It does not flatten out. But I would certainly feel better spending more, increasing the budget as we've talked about before, if things go in that direction. But I didn't build the budget assuming that. I built it assuming other things. So yeah, we're going to have first class travel in there anytime soon? Nope. But maybe a special trip for an anniversary or a family event, or something that could happen. But no, that would not be our norm ever.
Never know.